income, the expense analysis that was used for the pro forma. I'm real good with that. And the appraiser's an MAI appraiser, which is, you know, the PhD appraiser. And the client asked what I thought. I said, I think the appraiser did a great job with the analysis, the income expense part of the appraisal, but the cap rate is way off. So again, what I did is I made a couple of phone calls. I called a couple of lenders. I said, hey, where would you be with the cap rate for a mixed-use building like this? And the appraisal was about 100 basis points off. So again, what I learned a long time ago, anytime you have an appraisal done, you always ask for what purpose. You know, what's the purpose of the appraisal? You know, it's for a refi, for estate purposes, where you want to inflate the basis. What's the purpose? You know, so when I looked at it, I changed the cap rate to the market cap rate based on cap rates of comparable properties that just closed within the past week. I mean, we're talking a difference of $300,000 okay? You know, on a $3 million gap, 10%. You know, that's huge. That's a huge number. Okay? So I guess what I'm trying to say is, when you do your analysis, there's a whole lot of legwork that has to be done. Don't rely on the rule of thumbs. Don't rely on, you know, the cost per unit, for example, the gross rent multiplier. I just saw a article. It wasn't really an article, was it? More or less an advertisement by a broker trying to sell multifamilies in Rochester, and he was looking at things like gross rent multipliers to come up with that. Okay? And the disadvantage of something like that is you're only looking at the income. So whether you have furnished units versus non-furnished units, whether you have one bedroom or you back up, maybe you have studios. You know, your unit mixes off studios. Well, that's going to play a big role, especially if they're furnished units or if they're corporate units. You know, whether they're furnished, really high end. And but what about the expense to operate those? So that kind of brings you down to looking at things like the cap rate, which takes into account, you know, the net operating income. So takes into account the expenses. So that kind of is a better gauge, but you should never rely on rule of thumbs. You know, we talk about different rule of thumbs. A lot of people just look at, you know, what's my cash on cash return in year one? When you buy real estate, you buy it over a holding period, right? You're locked into the acquisition for a holding period. So you need to look at all four benefits, not just the cash flow. You know, we do a lot of co-ownership deals. They're called DSTs, where you buy into, it's like a REIT, but it qualifies for 1031 purposes. You buy into these deals, like $100 million offerings. But you look at the cash flow, benefit number one, right? Cash flow before taxes. You're looking at about 5% in year one. Okay? But as the rents increase, the value increases, the cash on cash return increases. Okay? Well, what about over the holding period? So historically, that same investment historically has averaged about an 8 to a 10% overall rate of return, what we call internal rate of return, which basically takes into account all four benefits: cash flow, equity build-up, depreciation, and tax benefits, right, over the holding period. And that's really a better gauge to measure your investment, you know, how your investment's doing. You know, you just can't look at 1 year, because I can show you deals where you may have no cash flow in year one, but over a holding period, based on the economics, in Tampa, for example, I'm just in that market, you know, you can buy deals that have very low cap rates. You know, the lower the cap rate, the higher the value. And in year one, you may even have a negative cash flow before taxes. But when you do what we call a cash flow analysis, when we analyze that transaction over a holding period, okay, you can kind of back into, you know, what's my net present value going to be? What's my internal rate of return going to be? What my overall rate of return over that holding period? So you can't just take a 1 year snapshot. Okay, but that's what we're going to start with tonight. Year one snapshot. Okay. Do you have any questions before we start?
How do we come with cap rates? How do we come with that?
Where does the cap rate come from? It's extracted from the marketplace. There's many different forms of capitalization rates. The simplest is what we call market rates. And that's extracted from the marketplace. And what I do is I talk to appraisers, I talk to lenders on a weekly basis. What's the cap rate? Now, there's been an adjustment to interest rates, right, recently. So I always look at, the difference between the spread between the interest rate and the cap rate. Okay? You have to have so many basis points spread positive to generate your cash flow. So as a rule of thumb, and again, I'm not a rule of thumb that guy. I gotta have, anywhere from 100 to 125, 150 basis points between the difference between the cap rate and the interest rate. So the interest rates just came down, didn't it? I just talked to a lender today, they quoted me 6.25% on multifamily deals. Okay. So that being said, my cap rate has got to be at least 7.25, 7.5 for the deal to make economic sense, where the cash flows the way you want it to cash flow with the amount of risk that's involved in the multifamily deal. Now, each property type is different. Okay, we do a lot of the Dollar General deals, brand new development deals, and because the interest rates were so high over the past couple of years, there hasn't been an adjustment with the cap rate in the marketplace. So the only way we're able to do those deals is we bought for cash, because the cap rate was 7. So if you bought at a 7 cap rate, you have no debt service. That means your cash on cash return is 7%, meaning it's the cash flow, the relationship between the cash flow before income tax and your capital investment. So if you pay cash, you're looking at a 7% return on your capital. But where does the cap rate come from? It's extracted from the marketplace, right? We convert the income stream into value. It's the process of capitalization. I'm going to show you how that's about. It's a real simple formula. It's something that's a much better, if you want to use the term rule of thumb, than a thing like the cost per unit, gross rent multiplier. Okay. All right, so let's take a look where we're at. Intro. Here's an income approach. So again, as I mentioned, this is based on the income approach to value. And typically an appraiser, when they're developing value, it's based upon five or more units. Okay. And a small multifamily with 4 unit, they're not using the income approach. They're basically using the market approach. Like that's something you can use like for singles and doubles, right? Rather than basing the value on the income stream that the property provides or is thrown up. So let's take a look at a case study. Let's assume that we bought a 12-unit apartment building back in '83, and the value was $240,000 in 1983. We put $60,000 down, and we leveraged our position here, the difference, right? Typically, a 75% loan value. Realistic, we're looking today 70, 75%, just about with any lender. So we went out and we controlled $240,000 worth of real estate, a 12-unit building, with $60,000 down. That's our equity position. Now here we are in 2025. We're disposing of this asset, and we want to take a look at where we're at in value. So we're going to use the income approach to determine that. But during the holding period, we added additional equity build-up, right, through the principal paid out of the mortgage. So that mortgage back in 1983 was $180,000, and that's a zero today. That's zero. So I can't tell you how many clients that we have that they think the best thing to do is to own real estate and be mortgage free. That's a great concept with your primary or your secondary residence. So no matter what happens in the marketplace, you can sleep nights without losing those assets. But when you're dealing with investment real estate, if you want to maximize your rate of return on an after-tax basis, you need to be leveraged. Now, how do you do that? You can either do refis, you can do 1031 exchanges. You keep on, if you started with $60,000 down today, okay, and you use 75% loan value, you want to keep on using the maximum leverage so that you're going to see that this asset grows to $900,000. So you don't want to be in this asset and be $900,000 of equity and only controlling $900,000, because because with the use of leverage, apply the same concept, 25% down of 900,000, just take 900,000 divided by 0.25, and you can control what? 3.6 million of real estate. Right? It's like a light switch going up, you know?
No, like that, are you better to sell it and then use it, or just refinance it, then you have that property still and have the new property?
Right. It all depends on what we call the U factor.
Okay.
Is the property on the right side of tracks? How's the management of that asset? What's the tenant profile? What's going on in that area? Is it up and coming? Is it growing? Is it declining? So that's really an individual thing that you have to look at. Because both tools are great. You may have a portfolio and you may decide, these are great properties. I'm just going to continue to operate it, and I'm just going to do a refi. You're not going to crank 100% of your equity out, but if you can crank 75% up, tax free, and continue to own that property that you did the refi on, that's not so bad. Okay.
If you do a refi, you have to do a 10, no, you don't have to do a 1031 because there's no capital gains.
Right, it's not a sale, right, it's tax free. The capital that you just cranked out. Versus if you did decide to dispose, again, there's no better way than to do a 1031. You can pull out 100% of your equity tax free. And with the use of leverage, that's the formula for financial independence, right? 1031 and leverage. So we're going to show you that as we go through this. So I wanted to break this down as a case study for you. So let's take a look at what we call the ERB equation. How do you determine value? Okay, how do you determine value? So the ERB equation, here it is on the bottom. It's a formula, right? I represents income, meaning the net operating income, right? So we start with what we call our potential rental income, right? From that, we back out our vacancy and credit loss. We add our other income in, like laundry, and at that point, what am I missing? Rental income, less vacancy, credit loss, and we have other income. And that'll give us our gross operating income at that point. Okay. Now, depending on where you've been schooled, like you've been schooled through the Institute of Real Estate Management, the concept is the same, but they use different terms. If you were schooled through the Commercial Investment Real Estate Institute, the concept's the same, but different terms. Okay. But it gets you to the same place. You're operating your collectible income, gross operating income. And then you take all your line item expenses, right? And that leads you down to the net operating income. So that's the I that I'm referring to. That's the I. The I represents net operating income. And that's the value that we use to convert into value. That's the income stream that we convert into value. Okay, so that's important when we're dealing with investment real estate. Rate, cap rate, we extract that from the marketplace, from the comparable sales. Okay, so we have a file in all the cities that we do business in. We just keep on updating it constantly. We get a lot of appraisers that call us looking for comps for sales, because we're getting that firsthand, when we're doing 1031 deals with clients. So we kind of share that information, with the lenders, with the appraisers. So everybody's on the same page. And then what we've learned is, okay, tell us, Mr. and Mrs. Lender, what's your formula? What line items do you use for financing purposes? And that's how we kind of back them together, so that we're on the same page. So we want to be realistic with the seller. One of the things we never ask a seller when they ask us to market, a multi-family deal, we never ask them, what do you want for your property? Because they'll tell you they want $10 million when it's worth $1 million. Okay. So what we do is we'll tell them, hey, we'll do our analysis, and we'll give you a range of value. What the market, what you expect to achieve in the marketplace. So we'll give you a range rather than, okay, it's worth $10, and that's it. You can't set the All right, so the process of capitalization is nothing more than converting the income stream, the net operating income, to value. So if you know two of these factors, if you know two, you can solve for the third, the unknown. Right? If you know two, you can solve for the unknown. So if you're looking for value, if you know the income, the net operating income, you extract the cap rate from the marketplace, from the lenders, from the appraisers. You divide the two, that'll give you value. Okay. Known as the Erb equation. Okay. The Erb equation. So hang on to that thought, because we're going to use that to go forward here. So let's take a look at this case study. So one of the first things, whether we're looking at the acquisition of a property or whether we're looking at marketing on behalf of a client, one of the first things I want to see is the current rent roll. And I want to have that certified, because I don't want no surprises, the day of closing. Well, what do you mean now there's 10 vacant units? My income just went from 30,000 to 20,000. Well, we've had that happen. I mean, we've had deals that had to be adjusted by by 6 figures. By 6 figures, because the people think they just can write on the back of a napkin as the sellers, yeah, this is my rent roll. Okay. So we've learned a long time ago, we provide our forms to our clients, and we have them certified that this is for real. This is what you showed, in your Schedule E as far as your income and expense, and here's the current rent roll, and you're going to certify that, yeah, this is for real, because that's how we're developing value, right? Okay. So if you take a look at this, no-name apartments, 12 units, anywhere USA, we break down typically the square footage, the number of units, the number of bathrooms, number of bedrooms, the contract rent, the actual rent, and then we show the market rent as well. Okay. So here you are today versus where you can be. But again, you have to take a look at the condition as well, right? But so that's one of the first things we do is we do a rental survey, right? After we start gathering this data, this rent roll, right? We gather that, we take a look at, here's our market rents in that trade area. Here's our actual rent, our contract versus market, right? Okay. So how do we know what the market rent is? So the next thing we do, once we have our current rent roll, we go to the marketplace in the trade area. We take a look at who we are competing against in our trade area. Who are we competing against in our trade area? And this is just one example of a rental survey. You can gather a lot of this information online. Apartments.com. I think on LoopNet they have a separate department now that they'll share this information with you. In the past, you would have to go to with a clipboard to our competitors and kind of make friends with the property managers and kind of share this information. Much easier today, with the computers. But basically, we're looking at the subject property, Hidden Village, and then we're looking at some comps. Garden Village, Edgebrook, Kingswood. These are, we used to own Hidden Village. There's the west side, 4 units. But we would kind of look at the condition, we look at the square footage, kind of develop, okay, cost per square unit, the cost per square foot, we kind of back into, take a look at the conditions, and then we're able to determine where the rents can be versus where they're at, contract versus market. And I'm almost positive LoopNet has a feature that'll do this for you today. If you're familiar with LoopNet, I'm almost positive. Tony Ricciazzi, you guys deal with LoopNet. I think that's his department now. Yeah, that's a great tool because this will save you a lot of legwork. Any questions, guys? So far? We good? Okay. So rental survey, huge. Once you know. Here's my current rent roll. Where's the market? Where can I take this asset? Where can I take this asset? So from there, then again, this is data that we either have to ask the seller for, or the broker that you're dealing with, and then there's other information that you have to gather and run. So this is what we call an APOD form, an annual property operating data form. It's a 1-year snapshot, financial snapshot, 1 year. Okay? First 12 months of ownership. But basically, what we do is we take this APOD form, we gather the information that the seller gives us. Okay? And you may want to do a trend. It's very difficult to get this information, especially on smaller deals. You may want to look at like a 3-year history and see what the trend is, with your income and your expenses. But we're pretty lucky just to get 1 year, for the most part, from sellers. They're not as sophisticated as you think, guys. Most sellers. But what we do is we take a blank APOD form and we tell the seller, hey, we need your schedule leads. We need your last year or last 3 years, depending on the size of the transaction. We need what you show or what stand on schedule lead, both income and expenses. Okay? So again, we can look at where the trend is. Is the income going up? Is it going down? That'll give you an indication of maybe either the management or where that property's headed. A change in the neighborhood, for example. The tenant profile change. So for the most part, we call this a seller statement or a live statement. Okay, so we can't rely on this, and the sellers always leave out what? Vacancy, right? They never show property management. Every lender is going to show a property management fee, whether it's self-managed or not. Okay. They're going to show replacement reserve. Typically for multifamily, most lenders, 250 units, $250 per unit. Annually. Again, keep in mind, this is an annual sale. Okay. What else don't we see? What do you guys not see when you guys are doing your
Admin, so general admin, if they have office expenses and stuff, well, not on a property this size, but bigger properties, you have general admin expenses.
Yeah, we were looking at a while ago, this was a number of years ago, we were looking at it was a 224 unit multifamily. And the appraiser, which I couldn't believe, basically does just multifamily, but then I understood why he did what he did. We were looking at this asset, and he didn't have a management fee baked in to the analysis. The one thing that I learned a lot of years ago, properties do not manage themselves. That's one of the strongest points you need to develop in this investment arena, property management, because that's going to dictate where your value is at. So I highly recommend. There's a textbook. It's called Practical Apartment Management, and it was written originally by Ed Kelly. He was the godfather of multifamily property management. It's put out by the Institute of Real Estate Management, IREM, IREM, and it's a great source to learn how to manage property. They put out a couple of designations. They have for site managers. It's called the ARM, the Apartment Accredited Residential Manager Designation. And then they have the big ones called the CPM, Certified Property Manager Designation. And they actually put out a book annually of all income and expense for multifamily for just about every city in the country. And they break it down per square foot, per unit, size, 12-unit buildings and lower, 24 units to the 12 to 24 units, 100 units or greater. Great source, because you can kind of, develop using your analysis, you can kind of develop some of the numbers where you should be. But then you can develop that same information once you are comfortable with the marketplace. you'll know what the expense ratio should be in that marketplace for a building of that size and that age. Okay. Whether utilities are included or not included. You'll be able to develop some rule of thumbs that will help you get started in an analysis like this. Okay. So, again, the big things that sellers never show, they never have a vacant unit, they never vacant property management, they never vacant replacement reserve. So all we do is we take this blank APON form, called the seller statement, and we just plot this information. We just plot this information on a seller statement. Okay. And from there,
Want to put that on?
there you go. Okay, thanks, Brandon. Thank you. From there, we do what we call a reconstructed statement, a buyer's reconstructed statement. So what I'm trying to develop here is our first 12 months of ownership, a 1-year financial snapshot. So let's assume that we're looking to make an acquisition of this 12-unit building. It's November. Okay, typically take us, in the Northeast here, 60 days to close. Let's just assume that, we're going to take title in January 2026 of this asset. Okay, so I want to be able to match my income with my expenses for the same time frame. Okay, I don't want to show income for 2 years from now and expenses from last year. Okay, because that's you'll never achieve what you're trying to achieve. And the thing that's crazy is once you lock yourself into an acquisition, you have to live with that asset for the holding period. So you don't want to screw up with this. You got to match the income and the expenses. This is year one. We're developing year one. And then what we can do is once we get sophisticated, we could actually take this into what we call a cash flow analysis, which is not just year one, but over a holding period, making certain assumptions. We can make certain assumptions at that point and, project what our income is going to increase each year, what our expenses are going to increase each year, and then we can arrive at what we call over a holding period, an internal rate of return. We can back into a net present value based upon what return we're looking for each year, and then determine what our purchase price should be, okay? But tonight I'm just showing you this 1-year financial snapshot because this cash flow analysis is a little more sophisticated. And actually, you can take any software, any real estate investment software, to use that software to develop this cash flow analysis. Just about every with technology today, there's all kinds of programs that are out there. Okay, but take a look what we're talking about. This presentation, incidentally, I sent you guys a PDF of this. So for anyone that wants this, I don't know if you guys are just emailing them out or if anyone is interested.
If you're interested, email Brandon@chrisnago.com.
Did you not get it yet?
I did.
Oh, you got it.
No, I'm telling them.
Oh, okay. I'm sorry. I'm sorry, Brendan. Okay. All right. So let's take a look at what we're doing here. Remember, what we did is we went out, we took our current rent roll, we did our rental survey, we took a look at where the market is. And we found out that, for the upcoming year, we're acquiring this asset. We're going to take title in January. We found out our rental survey basically said, you know what? We can increase these rents by 3% based on the market. Okay, we can increase these rents by 3%. So what we're doing here is we're going from, here's our actual, okay, current rent roll, contract rents. And keep in mind, if you guys are under leases, the leases run with the conveyance of title. So you have to honor those leases, you know? So you're locked into those. But again, if we're buying this asset in January, you know, we're going to be locked in for 12 months, and typically your leases are what, a year for residential? And then if they're not renewed, that tenant becomes what we call a holdover tenant and reverts to a month, right? Most lenders require leases though, okay, in multifamily. So depending on your property management, you know, where you're headed with it, whether or not you want to use leases or not.
For the financing, is a month-to-month lease considered a lease, or do the lenders want to see a 12-month lease?
Depending on the lender and how aggressive they are, you know, there's a lot of lenders, large financial institutions that don't want to lend in real estate unless it's like a $10 million deal. You know, so, you know, you might have been a good client of theirs in the past, but, you know, their game plan may have changed. Then there's a lot of smaller lenders that are hungry, especially new lenders that might be just setting up shop. Canal Bank, you know, if you guys have dealt with Canal, Vince, who used to run the mortgage department, commercial mortgage department for Evans, is the president of Canal. And he took with him Evan Maloney, and
Just so everybody knows, they will do line of credits on investment properties.
yeah, which
Canal.
Canal Bank, yeah.
They just won't go out my way.
Where is it? Canal?
Yeah, they're right on Main Street in Williamsville. They went into the old Bank of America location by the Glen Park restaurant.
Oh, I have seen them there.
I got,
Yeah, they just had an open house.
if anybody's interested, I got Carrie's number on my phone.
Yeah, Carrie came from Evans Bank too.
Lady that takes care of the business part, so this is stuff.
Yeah, Vince brought, he's got a great team there. He brought Eric over from Northwest. Eric did about $100 general deals for us over the years. He's with them. David Paul just came over from Bank on Buffalo. They got a great team, you know, great team. They're killing it over there.
Where are they originally? Like, are they part of a bigger bank?
They are. They have about 100 branches.
And they're all Canal Bank?
They go by a different name. And I can't even tell you what it is, to be honest with you. But I mean, for me, these are guys that I've dealt with for, you know, the last 20, 25 years. And Carrie was at Evans too, Jen. She came over. But my point is, you catch new lenders, small lenders, that's where you get your best terms. You know, that's where you're going to get your best deals from. But some of these larger lenders, I mean, people we used to do business with, like even M&T today, you know, it's just Key Bank. You know, they don't want to know anything about real estate unless it's a $10 million deal. So, you know, again, we're talking 12 units here. So basically, let's look at where we're at here. So we are doing a reconstructed statement, 1 year snapshot. We're looking at an acquisition. We went to the marketplace. We found out with our rental survey that, yeah, you know, we can pass on, you know, that first year of ownership, a 3% increase. And that's what I did here. We went to the marketplace also. We went to a lender. We went to lenders or appraisers. Hey, what's the vacancy and credit loss rate that we should be using? And again, even lenders are guilty of this. You know, they kind of use rule of thumbs for these line items like vacancy, you know, where they're showing like 5% vacancy for everything, 5% for management. Is it? I'm sorry, guys. I thought I turned this off. I don't know why it's ringing. It's on silent. My wife. Okay. So we find that even the lenders are guilty of this, more so on these smaller deals where they're using these rule of thumbs, you know, for vacancy, for property management, for replacement reserve. So we kind of back in, you know, we're redeveloping what our income is that we should be able to count on for our first 12 months of ownership. Okay, so basically, you know, we're showing the difference of income, 3% increase over that, you know, that first 12 months of ownership. We're showing our vacancy, We're extracting that from the marketplace. So make friends with some lenders, with appraisers, guys, huge, okay? And then basically that leaves us what we call our effective rental income. From there, we add other income, laundry, for example, parking, garages, okay? We would kind of bake that into that line item there, and that would leave us with what we call our gross operating income. Look, we're going down instead of up, okay? But we're trying to be realistic here, guys. We don't want any surprises. That first year is so critical. And what we find is when we take over a project, typically we find that there's an increase of vacancy just because of change of management, of ownership, maybe different style, we're doing different things. We're weeding out tenants, things of that nature. So this is where the work really begins right here with the expenses, right? So we have to go out and utilities. That one's pretty simple. We can go to the utility companies and find out, hey, what do you guys anticipate the increase to be for the next 12 months? Okay. And we show that, gas, electric, look at, we showed a 3% increase. Electric, same thing. Water, sewer. And that's a big expense. You don't want to leave water out, sewer out, trash. Those are big expenses. So we're kind of redeveloping and we're adding the line items that the seller did not tell us about on that seller statement, on that liar statement, okay? Repairs and maintenance, guys, again, we see a rule of thumb all the time for that one, of 5%. Again, depending on the condition of that community. So we've increased that. Well, we're showing a 5%. We see that line item not being in existence for most of these smaller deals as well. The sellers, most of them self-manage, and they never put a management fee. They never have any CapEx. They never show any repairs or maintenance. Never show any supplies. Management fee. Again, we have to bake a number in there because every lender, every appraiser is going to do that. Typically for multifamily, they're using 5%. And so we're just going down this list, guys, and this is where the legwork comes in. There's no easy way of doing this, all right? Insurance, you have to call that insurance broker. Here's the value I anticipate paying. What's my premium going to be? And I want to make sure that I'm getting coverage for replacement. For replacement, guys, huge. Most lenders will require that. I had a brand new vehicle, 2-week-old vehicle down in Florida that got hit by the hurricane last year. 2 weeks, I drove it once. I had 4.5 feet of water in it. It was totaled. But I was able to get the coverage that, because typically you drive your vehicle off the lot, depreciated at that point. They sent me a check for an extra $1,500 because I had the extra coverage for replacement. So even with personal property, like vehicles, not just real property, but you got to make sure you got replacement. You have to have replacement, guys. Big difference. And in the past, a lot of lenders weren't requiring it. Most of them are today. Insurance. Real estate taxes, that's always a biggie, right? We're always trying to play games. We want clients to set up LLCs so they can buy the membership interest because they think they're going to skirt around the reassessment. That ain't happening. In New York State, we have what's called the Welcome Stranger Act, which means that they can't reassess you based upon a sale. It's illegal. A lot of municipalities will have a form letter, and upon the conveyance of title, change of ownership, they'll send you that form letter saying that we're going to increase your taxes because of the change of ownership. Okay, but that's not legal. So at that point, you just have to call your attorney and have them send your letter back. And we've had that happen to that municipality. Okay, they'll try to get away with it. But property tax is probably your largest operating expense, right? But we always try to bake in, an increase there as well. And, but it is illegal. They have to reassess. They can't spot reassess a property. They have to reassess a property type or an area, right? Isn't that what we saw in the city? with multifamily, not too long ago, where, the values were so low, and then all of a sudden, the city went crazy with value. And, but they just can't reassess upon a sale. Lender reserve, whether you put it before net operating income, after net operating income, the bottom line is going to be the same. But typically, we call it a lender reserve rather than just a reserve. But a lender reserve, typically lenders are requiring a $250 per unit per year. I don't know how to turn this off, guys.
It's your wife, you should answer it.
No, it's not. It's on orange.
I know the rules of engagement.
I don't get it. I'll keep it here, just closer to me in case it rings again. I apologize. Okay.
In the truck.
Yeah. So here's where we're at, guys. We're at our total operating expenses. Look at the difference. Seller statement, reconstructed statement. It's a big difference of value, right? I mean, if you take, it's a $20,000 spread, just take that number and apply a cap rate and look at the value that you would be overpaying for, at that point. But this expense ratio, once you start analyzing properties in a given marketplace, you're going to know, whether utilities are included and not included, where you should be as an expense ratio for that marketplace, whether heat and water is included, whether all utilities are included, whether no utilities are included. You can come up with a expense ratio as a percentage in any given area, in any given property type as well, okay? So once you start analyzing deals, you'll get pretty good at this, So our net operating income, seller statement, just about 96,000. So look at where we were at, 72,000. For that first 12 months of ownership, matching income and expenses in the same period of time. All right. So what's the importance of that? So you as a buyer, okay, you're looking at your net operating income for your first 12 months. You extract the cap rate from the marketplace. Look at the value that we came up with. That's the same 12-unit building that we bought back in '83 for $240,000. So how is that possible? How did we go from $240 to $900? Obviously, we had to increase our rents, right? As we increase our income, we increase value, what we call the process of capitalization or the IRV equation. So today, that value, based on those rents, our rents probably went from $400, $500 to $1,000, $1,200, okay, to justify, where we're at today. Okay, so we're looking at an estimated market value based on the income approach, right, of $900,000. So we can kind of take this down a step, and we can take our net operating income, we can factor in our debt service. So we have our net operating income less our debt service, assuming a 75% LTV, just like at acquisition when we bought this property for $240,000, right? I'm showing an interest rate of 7%. That rate's down today, but again, this is just a case study. 25-year AM, we could definitely get a 5, maybe a 7-year term today, realistically. And that leaves us with our cash flow before taxes, $14,000, right? So cash flow before taxes of $14,000. So what does that mean? So that means that if we bought this asset for $900,000, okay, and then we look at what are our acquisition costs? If you're buying a income producing asset, you're going to have attorney fees, you're going to have an appraisal, a phase 1, right? Mortgage tax. So what I like to do, I call it the investment base. Rather than just the equity, the down payment, I take the down payment plus these costs, I add those together, and that's what my investment is, right? Out of pocket, right? Your investment base. And I show my rate of return based on that, okay? So I look at my acquisition cost, I look at my investment base now to acquire this asset, $234,000 as our investment base. That's what we need to control this asset, which would include the equity, closing expenses, okay? And now I can measure my cash on cash return against that number, not just the equity, not just the down payment. So year one, we're looking at a 6.3% cash on cash return. So a cash on cash return is the relationship between the cash flow before taxes and the equity investment or the investment base, okay? So in reality, you're looking at a 6% cash on cash in year one on this deal.
Where does the 900 come from on there?
The 900 came from taking that new NOI of 72,000 and applying that ERV equation.
Was it the 72 times 8?
72 divided by 8.
72 divided by 8?
Yeah. So if I go back here, right, remember this right here, the ERV equation? All it means is that here's my 72, right? And here's my rate. I divide the two, and that'll give me value. So when you look at, if you know those two factors, you're dividing. So depending on that formula works in a number of different ways, depending on what you're solving. So if you're solving value, you're dividing income, net operating income divided by cap rate will give you value. So that's what I did here, right? I took my net operating income on my reconstructed statement, I divided it by the cap rate of 8, which I extracted from the marketplace, and that gave me a value of $900,000 today. So if you wanted to buy this asset, this 12 unit, and based on this income stream, based on the cap rate, the interest rate, really the interest rate doesn't even come into play, but it really does if you think about it, right? Because when there's an adjustment to interest rates, there should be an adjustment to cap rates. There should be. Whether or not it happens, think about what's just happened. We just saw our interest rates go down 50 basis points, 25 and then 25. We're talking about reducing the Feds another 25 by year end. But the needle hasn't really moved, with values or adjustments, with the two interest rate adjustments that we've seen recently. Okay, so let's continue with this. So here's our case study. So this is what we call a cash flow analysis. So I showed you a 1-year financial snapshot, and we can kind of carry this over a holding period, and we can kind of calculate what's our overall rate of return, what we call an internal rate of return, that not only takes in one benefit, which is benefit number one, cash flow, right? You're getting a 6% return on your investment base at that point, year one. But I want to know, where's it going over a holding period? What am I doing? What's my overall return that takes into account all of my benefits, not just one, right? Where's my equity buildup going? Where's my appreciation going? I can even show my tax benefits over a holding period, right? And I can show this on a pre-tax or an after-tax basis. Either way works. So in reality, what I'm doing is I'm making certain assumptions, and they start in year one, right? They start in year one. That's year one. And now look at where my income is increasing. I'm showing that my rents are increasing 3% each year. I'm showing that my expenses are increasing. If I jump down here, and I don't know what rate, I think it's 3% as well. I'm showing that my overall expenses are increasing 3% each year. So look at my net operating income, how that's increasing. So we know as that increases over this holding period, the 7 or 8 year holding period, look at where my net operating income went, year one, from here to here. So now if we take that ERV equation, and typically we show maybe a 50 basis point spread from the acquisition cap rate to the disposition cap rate over a holding period. We kind of increase the cap rate about 50 basis points. So then if we take that ERV equation and apply our cap rate based on this income stream, net operating income, in year of sale, and divide by 0.0850, 8.5, that'll give us our value at the time of sale. So our sale price, look at where it went from. We bought for 900, we're looking at $1,050,000 at that point. But look at what we've done. We've reduced our average annual cash on cash return, year one, okay, was 6%. The average is now 9. Okay, here it is right here, broken down each year. So in year 7, it goes up to 12, but an average cash on cash return. Projected internal rate of return is 15%. Well, what does that mean? That means that each year your dollars are invested, that investment base, through that holding period, you're looking at a 15% overall rate of return. And that's the reason you can't just look at your cash on cash return year 1 and leave it at that, 14%, because that's only one of 4 benefits. I'm not even showing you the tax benefits here. This is all pre-tax, okay? This is a great tool, guys. It's the investment analysis. With today's technology, there's a ton of these programs, okay? And you can use this to your benefit because you can measure this internal rate of return or cash on cash return, or cash flow, I should say, either pre or after tax. So what's the benefit of knowing this? You can determine where you're at in your holding period and whether it's good enough. I'm not showing it here. I'm just showing the overall internal rate of return over a 7-year holding period. But with most programs, it'll show you your internal rate of return each year, just like it does your cash on cash each year. The importance of that is you can then decide, is the rate of return enough in any given year with the amount of risk in real estate? And that'll help you make the decision of when you should sell. And typically on an average, anywhere from 5 to 10 years as a rule of thumb, even though we don't like to use rule of thumbs, to maximize these rate of returns, okay, to maximize these. So you can see what's happening just from benefit number 1, how that's increasing each year. But again, that's taxable, isn't it? Right? That's taxable. That's cash flow before income taxes. Okay. Any questions? We good? Okay. Brandon, I screwed this up again.
That was a 12 unit.
The thing's right here, you have to point it over there.
Point it down here?
Yeah, when you're switching it, it's.
Okay.
Yeah.
Not up here?
Okay.
Okay. Okay. All right. Now, look at what happens as your cap rate changes. Okay. Look at what happens as your cap rate changes. So a 7 cap rate, okay, the lower the cap rate, the higher the value. Most people think it's just the opposite. Okay. So if you go from a 7 cap rate, look at your value based on that net operating income. If you go to a 9 cap rate, look at your value. 10 cap rate, look at your value. Okay. So it varies, guys. So that's the importance of this ERV equation. All right. At acquisition, back in '83, again, we bought that property on a 10 cap. Here we are today. You're probably looking at about an 8 cap. There's your difference of value, as long as the net operating. But the net operating income went from $24,000 to $72,000. So now apply your cap rate and look at your value. Okay. So $900,000 value. We're debt free. We had no mortgage, so we have $900,000 of equity. Right? So, I mean, you can kind of take that a step further and say, okay, what can I do with $900,000? If I apply the same rule that I did when I acquired this asset back in 1983 with a 75% loan to value, you can take that $900,000, right? You can take that $900,000 and you can buy an asset worth $3.6 million with the use of a 1031 in leverage, right? So let me just go back a step. So if you decided to sell this asset today for $900,000, you then have to do another analysis. You have to determine, do I treat the transaction as a sale? Do I treat it as a 1031? And because this asset was fully depreciated, I can tell you right off the bat, a third of your selling price is going to be taxation.
So you'd really only end up with 600,000.
Yeah, 300,000 in taxes. So that's what this analysis does. You know, it kind of compares a sale to a 1031. The bottom line is, if you sell this asset for 900,000, assuming there's no mortgage, just to keep it simple, 300,000 in taxes, a third. A third. And again, keep in mind, you paid 240,000 for that asset back in '83. But now to make Uncle Sam your partner and give them a third of your selling price, when in reality, that same asset sale, and you don't need the cooperation with the buyer to do the 1031. If you dispose of that asset for 900, you'd have 900, 100% of your equity to reinvest, right, back into real estate. And so the benefit of that is that using 900,000, just as a rule of thumb, and again, I don't like to use rule of thumbs, but a cost per unit of typically $100,000 today, you can now control 36 units instead of 12 units. You didn't double, you tripled your portfolio by just being smart. You didn't do anything really crazy here. All you're doing is saying, okay, my value is 900 because I increased my rents, I increased my net operating income, I increased my value. And with 900,000, to be smart, you can say, okay, with the use of leverage, okay, 900,000 divided by 0.25, the equity down payment requirement, because any lender will lend 70 to 75% LTV, right? So if we use 75%, that means we can get a mortgage of 2.7. We can control $3.6 million worth of real estate. Now, whether it's one deal or multiple deals, and they can be anywhere in the United States, the point is, from a money manager's point of view, you just took your 900,000 of value, and now you can control $3.6 million of value through the use of a 1031 exchange, which is a whole different topic, guys, and the use of leverage.
Can you do that more than once? Keep rolling to the next property?
Every 12 months, over and over again,
Same property?
until you die.
And then when you die, you want to pass down your kids?
Yeah,
Is
they
it
get,
tax-free still, or do they have to?
it's tax-free to your kids. It's tax deferred today to you, but when you die, it's tax-free to your kids.
Then they disappear.
Exactly. They get what's called the stepped-up basis. It's one of the best estate planning tools.
Just keep doing it until you die.
Yeah,
Stepped up basis?
yeah, you get a stepped-up basis from an accounting term. Swap till you drop, that's the whole concept, you know? So now you're keeping 100% of your equity working for you at all times, and you're maximizing your leverage that allows you to control more real estate. Again, this strategy, guys, is used with investment real estate. Now it's your primary or your secondary. You know, one of the best tools to get involved with today is, if you don't have capital to start with, tap your home equity on your primary. You can crank your equity out on your primary tax-free. And not only, you know, getting a home equity, but you can sell your primary every 2 years today, as of 1997, and you don't even have to reinvest into another primary. It's tax-free, as long as your gain per spouse is no greater than $250,000. So married couple has an exemption of $500,000 of gain, not value, gain, and they can do that every 2 years. So if you don't have that equity to start with, the best place to get started with is tapping that primary residence to give you that equity to start this chain right here. Okay, because, I mean, look at what we're talking about. We went from 240 of value to 900. And I remember those guys. I remember looking at deals, 10,000 a unit back then, you know, in the 80s. And where we're at today, as a rule of thumb, and again, I would never recommend rule of thumbs. Typically, you're looking at about 100,000 on an average per unit today. Okay, and you know, who would have thought? But look at the rents today, where we went with the rents. New construction, you know, a 900 square foot unit, you know, new construction. I mean, you have to have $2,000 to justify the cost of new construction today. You know, 800, 900 square foot units. And, you know, you have Brian Young and you have Paul Bliss. They just keep on adding new inventory. You know, Brian has a real nice formula that most people don't have. You know, he can go out with lines of credit and build at cost, and he's like Benderson. He's basically a general contractor building at his cost. Where if you and I went out, we would hire a project manager or general contractor, and our costs would not be the same. But it's a great opportunity. Any questions, guys?
With 1031s, do you do those nationwide?
We do, yeah. Yeah, we're based in Buffalo. We're headquartered in Buffalo, but we do 1031s all over the country. We pride ourselves on the fact that we can, once we're engaged, that same day we can have you set up with the use of technology today, where I have a team that I do every deal. When you hire us to do a 1031, I speak to every client. All of our phone lines come to me, to my cell phone. So I speak directly with that client. They get my 45 years of experience. If they decide to engage us, all we need is a copy of their contract of sale. Before we get to that point, we have a list that we have to have that potential client answer to make sure it's a good 1031 exchange. And then my team then prepares the docs. We email them out. They can DocuSign the same day. Because most of our business nationally comes to us where the closing's 24 to 48 hours from closing, which is crazy. But that's just the nature. That's the nature of the business.
Now, you said you could do one 1031 exchange every year?
You need to have a seasoning period in between 12 months. There's no case law. It actually comes down to the intent, and there's really no case law that states how long, but we've been using 12 months like every other qualified intermediary.
You have different LLCs.
That's fine.
Can each LLC do one every year?
Absolutely.
You're saying a property, per property.
Yeah, yes, yeah.
So even your personal name, you do multiple.
Yeah, whatever the entity or name is that you dispose in, that's how you have to buy the replacement. Yeah.
Now, is there a number where it ain't really worth doing a 1031?
You really need to have a gain about 20 grand or greater,
Okay.
which is
So even
teaching
like
the
a
beans.
if you sell a place for $60,000, but you bought it for $20,000, it's
Yeah.
still worth doing a 1031.
And what you have to remember is the recapture depreciation, not just the capital gain. Okay, because the recapture depreciation is a flat tax of 25% federally, no matter what tax rate you're in.
On 20,000, you get like 1,500 a year depreciation.
What was your number?
The number to call you. I had somebody in Money Tank recently that needed this.
Our number is 675-1500. You know what, I even brought cards tonight and I left them in the car. I forgot them in the car.
Sorry, 15?
But yeah, 675-1500. It's right on the presentation. And our website is just rjgullo.com.
Oh my God, I just texted him and he said you already spoke to him.
Who's that? Do you know?
What's his name? I can't remember his name. Darren Mendito?
Okay.
Is that, I'm sorry, no, that's not his name. That's somebody who was saying, this guy. I don't know if you saw him, but probably didn't see him.
No.
You talked to him today. I don't.
Oh, okay. All right. We don't even get to
Here I
meet.
am trying to refer
We don't
you.
even get to meet these people anymore. Everything is by phone and today.
Is phone the best way to get a
So
hold of
even
you?
Yeah.
Just for anyone who's listening on a replay.
Yeah, because you're going to get me. Yeah, our phone number is 716-675-1500. Our web address is just rjgullo, spelled GULLO.com. And you can just go to contact and hit us with your questions, and we'll answer the phone, when you're calling, not a week later. And
Can I read what he said about you?
yeah.
Said he's a real piece of work. Just kidding. He said, did today, class act, going to do business with him, quick response, reasonable fee, thank you.
In this deal right here,
Somebody that doesn't even live anywhere around him.
North Carolina?
Mhm.
Okay, yeah, I spoke with him this morning.
I can't live it on.
This deal right here, where the tax was $300,000, $900,000 sale, it cost $2,500 to save $300,000. That's what the total fee would be. That's, that's out of the relinquished into the replacement, everything. We prepare all the exchange docs, not your attorney. We're not going to rely on, an attorney that's done one in their whole career. And we provide a 6-month advisory service as well. So We can't give tax or legal advice, but we have a research center. You know, we've done over 25,000 of these nationwide. And so over the course of time, we developed a research center, and just about anything that you can think about that may affect the 1031, you know, we have the case law on that. So we can explain it to the client, we can provide the case law, we can give the case law to their attorney or their CPA. We just can't give their advice. They have to give us the green light, saying, yeah, okay, it's good to go. Okay, so as I mentioned, guys, the formula for financial independence, 1031 exchange with the use of leverage. It doesn't get any stronger or better than that. And this just has to do with 1031. I know the whole presentation was based on multifamily. We do give free consultations, but we also do a free, what we call a property value estimate, multifamily property value estimate, you know, to give individuals an idea of what their assets are worth. That's it, guys. Questions? Any questions? Services, okay.
So for us, mostly newer investors, getting involved with the multifamily, you would suggest using home equity loan?
Well, if someone doesn't have capital, you know, and you can't bring a partner in, the home equities are great because typically the lender absorbs the cost of it, and they're pretty quick to get done. And the interest rate is very favorable, you know. And you can tap these lines of credit, these home equities, and it's tax-free. You know, you can use those funds with anything. You can go to OTB with them. You can do anything you want with those funds, you know.
I think it's something just good to have. It's, you know, you don't.
Yeah, absolutely.
I built my own house, and then over the course of a year or so, I ended up having a HELOC of $223,000. So then I took that and immediately built $1 million building, commercial building.
It doesn't get any better than that.
Like I self-funded myself like $300,000 into a $1 million project before the bank even came there. I mean, I surprised those ladies when they're like, normally your first draw, like we're just grading dirt, you know, like I had the whole entire building down. And now like I just sit there and use it until a rainy day when you come across something.
Great to have.
Yeah.
Great to have. Yeah. And if you have any skills in the construction industry, think about just the primary residence. You have the opportunity to build at your cost. You move into that dwelling, stay there for 2 years. You sell it at the market value. And as long as the gain between the two spouses, the profit is under $500,000, you can crank that equity out, sell that property. It's tax-free. You don't even have to buy another primary with those funds. You can use those funds to do anything you want.
So I use Bank of Holland primarily for a lot of my courses of business. And so I'm really great with the relationship with them now. And they actually do vacant land loans. So not a lot of places do that. And what they actually also do is you could roll that vacant land loan into an overall construction loan, an overall mortgage. So I did that with my house and also with that commercial property, which is pretty unique. I mean, it's only 35% down for a vacant land. So I mean, if you come across something, it's, you know, without having the cash, some places, you know, they don't do loans on vacant land. So, like I said, that's somebody here locally as well.
Yeah. Those smaller lenders, guys, it's the way to go.
Do you work with George?
No, the East Aurora branch, I did my personal house through Peter Girdle, and then all my commercial, I switched all of my business accounts to them, and I use Michelle Maloney. She's right here in East Aurora. And now I mean, like,
I work with them.
okay. I mean, it's separately, but like that's how when I first came across her, she was texting me at 7 o'clock on a Sunday night, texting me about my deal, and it's like, what?
Yeah, imagine that. Yeah.
Does that?
Yeah.
Where I have their personal cell phone, you know, and now like she calls me and asks me advice about short-term rentals and stuff like that. We're very close now. So
Yeah.
it's like
You need a good relationship with the lender.
yeah.
And those small lenders, small banks, institutions, so that's where you get your best deals from, guys. At least that's been my experience. So, any other questions, guys?
I think we spoke about it before, but what's like the restrictions as far as 1031s on similar like properties? Like I guess that
Like kind?
Yeah, like kind.
Definition of like kind means any real estate that you're disposing of and you can buy any real estate, as long as you make it available for rental or hold it as what we call investment held, meaning for future value. Anywhere in the United States, you just can't use it for at least 2 years personally, personal use, because then it becomes a secondary residence. So we have what we call the sunshine formula, where we take people out of the Northeast, income producing, with the intent of retiring down maybe in Florida in the future. So, they'll buy maybe a condo today down in Florida, and they make it available for rental. And then after 2 years, they can make it a secondary or a primary residence. And there's no tax at that point because it's not a form of disposition. It doesn't get any better than that, guys. And you can rent to a family member in that, that first 2 year period. And you could actually gift the rent up to $19,000, I believe, a year to as many people as you want. So you can gift the rental income to a family member, and in return, they give you a rental check that you show on your tax return. But now you can take depreciation, expense. So it kind of washes pretty much. If you don't want to rent it to a third party,
I think there's also the Augusta rule where you can rent your primary residence after that point for 14 days tax-free.
2 weeks, yeah. Matter of fact, remember when the Olympics were in Atlanta? I don't know how long, what's that, about 20 years ago? That's when people found out that, hey, I can rent my house, my primary, for 2 weeks, the time of the Olympics, and I don't even have to report that income for that period of time, So that's it, guys. If you guys want a copy of that presentation, I guess you just need to.
Brandon at Chris Nagle, I want you to say that right there on mine.
Beautiful.
Can you say it so I can hear it on
And
mine?
Brandon will get you a copy.
Just say,
What's it?
so email Brandon at chrisnagle.com.
For a copy of this evening's presentation.
Is there a fair amount of smaller multifamilies that, to get started into, or are there most of them, larger scales where?
There's very few large-scale properties in Western New York. It's just the makeup of our market. Most of them are small. Yeah.
6 units?
Yeah, absolutely. Absolutely.
Except the ones that-
So like a 6 unit, just roughly, what would a person need roughly to get into a 6 unit?
Maybe 150. Yeah, somewhere between.
Gives an idea,
Yeah. Yeah. So, well, guys, I want to thank you for giving me this opportunity. Hopefully you learned something from it. If you have any questions, again, you can either call me at 716-675-1500, or you can just go to our website. It's just rjbello.com.
Thank you very much.
Thank you. Thank you. Thanks, buddy.
Yeah, I got a couple single-family homes that I've been thinking about disposing, because, take a whole lot off of my